All right, let's jump straight into this explainer. Today, we're popping the hood on DiamondRock Hospitality Company. You'll see them trading under the ticker DRH. We're going to unpack exactly how this massive hotel real estate investment trust manages its premium properties. And more importantly, we're going to figure out how the market is actually valuing their stock right now.
To kick things off, check this out. 33 million bucks. That's the exact price DiamondRock just got for offloading their leasehold interest in a Courtyard by Marriott right in the middle of Manhattan. Now, you might be wondering, why on earth would they sell a perfectly good New York City hotel? Well, that specific decision is really the master key to understanding their entire strategy of capital recycling.
So, here's the game plan for our explainer today. We'll start with their strategic moves, move on to their financial engine and dividends, dive into the industry risks they're facing, and then tackle the big valuation debate.
Part 1. Strategic moves. Selling high and renovating smart.
You know, running a successful REIT isn't just about hoarding properties like trading cards. It's about knowing when to hold, when to renovate, and, crucially, when to walk away. And that brings us right back to that $33 million Manhattan sale. CEO Jeffrey Donnelly essentially said this wasn't some desperate fire sale. Even though that hotel's net operating income had more than doubled since 2019, they were looking ahead. When they weighed the upcoming capex needs against structural expense headwinds, the math just didn't work. The expected returns didn't meet their threshold, so they made a highly calculated pivot to protect and grow their free cash flow per share.
And you can actually see the confidence in that strategy right here in their revised 2026 guidance. Even without that New York property in the mix, the numbers look really solid. They're still targeting comparable RevPAR, that's revenue per available room, growth of 1.5 to 3.5%. Their adjusted EBITDA is sitting strong between $290 and $302 million. So clearly, this strategy isn't hurting the bottom line, it's streamlining it.
Okay, so if they aren't dumping cash into that Manhattan property, where is all that capital going? Management has been super clear that they're playing small ball right now, hitting singles and doubles instead of swinging for massive, disruptive home runs. They've got over 400 highly targeted in-house projects going on. We're talking everything from modernizing elevators to cut down on service calls, to tweaking restaurant layouts to boost revenue. Plus, when they renewed their Westin agreement up in Boston, they purposely turned down expensive key money loans just to protect their balance sheet. It is literally all about driving ROI and preserving that free cash flow.
Moving right along to Section 2, the financial engine and dividends, basically the cash flow machine. So what does all this portfolio shuffling actually mean for your wallet as a shareholder? Well, their priorities for returning capital are pretty straightforward. They've got a massive $137 million still sitting there in share repurchase capacity, and they're using it. In 2025 alone, they bought back 4.8 million shares for over $37 million. On their last call, the CEO straight up said that share repurchases are the most attractive use of their extra capital right now, which is helping them target a 7% growth in free cash flow per share this year. Now, take a look at this dividend history. As a REIT, they have to return capital to shareholders. But notice how it's definitely not a straight line. We've got 8 cents in Q3 of 2025, a nice bump to 12 cents in Q4, and then 9 cents in Q1 of 2026. This kind of fluctuating payout structure really just reflects the natural, seasonal cycle of their cash flows, while still actively pushing profits back to investors. Smooth all that out, and you're looking at a 3.10% annual dividend yield. For those income-focused real estate investors out there, grabbing a tangible yield north of 3% is a pretty solid anchor. You're getting rewarded just for holding the stock, while management executes their game plan. Which brings us to Section 3, navigating industry risks, the classic headwinds versus tailwinds. Look, no REIT operates in a vacuum, right? DiamondRock is right in the middle of a serious macroeconomic tug-of-war. On the bright side, the tailwinds are fantastic. Group business pace is up over 100 points, they're using AI to streamline administrative tasks, and they actually managed to lock in $1 million in insurance savings for 2026. But man, the headwinds are real. The hospitality sector is wildly cyclical. They're fighting rising national labor costs, general consumer uncertainty, and above all else, some intense interest rate sensitivity. And here is where it gets real. Look at this balance sheet. $1.1 billion in consolidated debt, with a weighted average interest rate of 5.0%. But here's the catch. Only 30% of that debt is fixed. That means a whopping 70% is floating rate debt, leaving their bottom line super exposed to interest rate swings. If borrowing costs shoot up, that directly eats into all that cash flow they've been working so hard to build. Finally,
Section 4, the valuation debate. Is this thing priced for perfection?
So with strong execution colliding with these looming macro risks, what's DRH actually worth? Just a quick refresher for those deep in the weeds. When we evaluate REITs, we don't just look at standard net income. We look at FFO, funds from operations. It adds back real estate depreciation and strips out the noise from one-off property sales, giving us the actual operational cash-generating power of the business. And looking at that cash generation, analysts are totally split. The bulls over at Simply Wall Street are saying the stock is actually slightly undervalued, putting fair value at about $10.90, thanks to that strong group demand and solid execution. But the bears at Treefus are pointing to a really glaring metric. DiamondRock is trading at a price-to-earnings multiple of 22.8x. When you compare that to the industry average of just 15.1x, the bears argue that paying such a massive premium, especially with that high floating rate debt, is just too risky. So here's the million-dollar question. Is the market already pricing in a flawless recovery? Are all the benefits from their smart capital recycling and those 400-plus renovation projects already baked into the stock price, leaving zero margin of safety if the economy hits a bump?
It's the ultimate trade-off. On one hand, you have a fiercely disciplined management team ruthlessly optimizing a cash flow engine. On the other hand, you've got a stock trading at a hefty premium compared to its peers while navigating some pretty choppy economic waters. So, looking at all the data, what's your verdict? Thanks for hanging out with me for this explainer. Keep analyzing, keep asking the hard questions, and I'll see you next time.